What's going on, money lovers? Welcome back. So today I want to talk about Facebook and Apple stock and which I think is the better buy. We're going to mainly focus on their Q1 2021 earnings report, and then I'm going to also give you a third option to buying, either Facebook and Apple directly. Another way that you could possibly own both of these companies and be very diversified. So first up, let's start with Facebook's earnings call. So their daily active users in Q1 was over 1.8 billion. Their monthly active users was 2.8 billion, and the amount of revenue they derived per active user was around $9, a little over $9 per user worldwide, and this fluctuates greatly based on, geographic region. As you can see in the US, it was closer to $50 per user. So they brought in 26 billion in revenue. Now, the majority of this was through advertising. Their operating margin was 43%, which is very good, very high operating margin. Net income was nearly $10 billion for the quarter. And in 2020, as you can see, they brought in, let's say, almost 30 billion, maybe around 28 billion in net income. Their earnings per share blew away estimates, came in at $3.30, and they have $7.8 billion in free cash flow. So a ton of free cash flow. They can use this. They don't pay a dividend, so a lot of that they can just reinvest right into the business and continue to grow or innovate. Now, Facebook owns a lot. They've got Facebook Messenger, they own Instagram, they own WhatsApp, and then some less talked about segments that I think have more future potential are things like Oculus, their virtual reality segment. So Oculus, this could lead to, virtual workplaces or games. There's a lot of potential, I think, here, but as things stand right now, Facebook doesn't make a lot from this, obviously. The majority of their revenue is derived from advertising, and more specifically advertising on things like Facebook, Instagram, social media. So if you compare Facebook to Apple, Facebook is definitely the less diversified of the two. All of their revenue is basically derived from advertising and social media, whereas Apple, you do get more diversity. They obviously have the iPhones, the Macs. We're going to talk about their revenue by segment, and they also are introducing more and more subscription-based models. They've got things like Apple TV, Apple Fit Plus, monthly membership. So let's take a look at Apple's Q1 earnings, and then I'll tell you which company I like more, and again, those an alternative to buying them directly if you want to pay a lower price and own both of them. Latest earnings, so this is for Q2 2021. Quarter record revenue of almost 90 billion, which is up 54% year over year. And international sales accounted for 67% of this quarter's revenue. So that's very exciting when you see a company expanding internationally, getting you exposure worldwide, adding to its diversity. Now, obviously, it's going to be tough for companies, big tech companies like Apple and Facebook, to continue growing at this pace. Now that we're coming out of lockdown, obviously, this was an extraordinary period that boded very well for companies like Apple and Facebook while everyone was essentially on house arrest. But then again, moving forward, I think the world has changed permanently from this pandemic, and who knows? A lot of these changes, I think, are here to stay. So I think Facebook and Apple are two of the best companies. They're going to continue to innovate, so they probably can continue to drive revenue like this. Now, that being said, I think it is a risk that now you would be buying in at a very high, and next year I wouldn't expect earnings to, there's no way earnings can increase another 50% year over year, let's just say. They might go up a little, they could stagnate, but I just can't see them growing that much over the next year in a world that is reopening. Hopefully. This is for Q2 2021. Total net sales of 90 billion. Their gross margin 38 billion. So roughly, let's say about 40%. Very good margins. So as you can see, it's good to see they're diversified internationally. They're bringing in significant revenue from Europe, 22 billion. 17 billion in Greater China. Apple has a great balance sheet, ton of cash on hand. And it's interesting if you look at their net sales by category here. So Q2 2021, iPhone accounted for 47 billion, but the other segments were growing compared to last year. Services are up to almost 17 billion, which is great. This is Apple's newer segments like Apple Fit Plus and Apple TV, things where they can get a recurring stream of revenue monthly, which is a great business model. Now, their wearable segments also made significant strides, up to 7.8 billion, iPad 7.8 billion, the Mac up to almost double, 9.1 billion from 5.3 billion. So these are great numbers, nothing to balk at. And it's good to see that they are driving significant revenue from something besides the iPhone. Even though that does still make up half their sales, they are diversifying, which is what you want to see. They're not diversifying like Peter Lynch hates when a company diversifies. These are all segments that provide synergy. So your iPhone, your Mac, your iPad, your wearables, and your services, they all work in tandem. It's not that they're getting into things that have no relation and they don't understand, I mean, its services are a great addition to complement iPhones and Macs and wearables and things of that nature. So it all relates. This is a 1 + 1 = 3 type of scenario. It's creating synergy. This is a good way to diversify, and I think Apple is going to be on top for the foreseeable future. So what are some cons here? If we look at Facebook first, it's obviously at, an all-time high here, $326. PE ratios are getting higher, but at the same time, I think you need exposure to these companies. I mean, these are the companies at the forefront. They're going to keep innovating. You want to own them. That being said, if I were to start buying Facebook here, I already own some, so I'm not in any hurry to buy it at the height, but if I own none, I would probably just start averaging in slowly, maybe even one share at a time, every couple weeks, if I wanted to build a position to scale. And same thing with Apple. Apple, $133 a share right now, pretty much an all-time high when you adjust for splits. And if we take a quick look at their PE ratio, so Apple PE as of April 28th was 36, so a little bit high, but still not super overvalued, but it is a little bit on the higher side. And then when we compare that to Facebook's PE is 30. So of the two, you can make the argument that Facebook is cheaper right now. And of these two companies, I would say Apple is definitely the safer bet. But with Facebook, you're going to get higher risk and higher reward. Facebook is often a target. There's all types of scandals and lawsuits, and the government's always after them, but they're kind of going after big tech in general. So that's definitely one big risk with these companies. However, it's not a risk that I see having a long-term negative impact. I mean, I think these companies are here to stay. They've revolutionized the world. So if you want the safer bet of the two, I like Apple, but if you want a little bit more risk, a little higher risk, higher reward, Facebook. But honestly, I would want to own both of these companies. I think they're both fantastic business models. They're here to stay. Now, if you aren't comfortable dishing out, paying a premium, buying these companies at all-time highs, there are other options. So one option is an index fund. So I own FSKAX because I use Fidelity. And with an index fund, here's the top 10 holdings. You get exposure to lots of different companies. So you get 5% exposure to Apple, and you would be getting 1.55% exposure to Facebook. In addition to all these other fantastic companies that you see here, here's the top 10 holdings that make up 20%, almost 22% of the assets under management here, and you're only paying $120 per share. You're getting a good chunk in things like Apple, Facebook, Microsoft, but you're also diversifying to protect yourself. And then another great option, so there's other options too, SPY, S&P 500 index, there's Vanguard index funds. They're all very similar. Check out my videos on index funds if you want to learn more about that. And another option would be QQQ, which is a NASDAQ index. So this just owns the top 100 holdings in the NASDAQ, $338 a share right now. And you'll basically be getting double the exposure. So instead of 5% exposure to Apple, you get 10%. Facebook, you're getting almost 4% here. So if you are more bullish on these big tech type companies, I like all these with the exception of Intel down here. I'm more of an AMD guy. But if you are into these other companies and you think, what's the point of diversifying further? Why not just own the best? I mean, here you can see these 10 companies make up 50% of the holdings. So again, higher risk, higher reward, but you could also make the argument these are going to be the best performing companies, moving forward. So I think both of these are great options. If you don't want to buy those companies individually, if you think they're overvalued and the risk is too high, QQQ is a good way to diversify, as well as an S&P 500 or total market index fund like FSKAX. So yeah, let me know in the comments below. What do you think of Facebook and Apple? Are you buying? Why or why not? So in summation, with Facebook, I think you're getting higher risk, higher reward. They're less diversified, and they're frequently being targeted and blamed by the government. A lot of controversial issues and scandals. But barring any, government intervention, their business model is fantastic. The way they're able to monetize users with very little overhead. They've got a high operating margin, $10 billion in net income in Q1. Their daily active and monthly active users have been increasing, but of course, year over year, we've essentially all been on house arrest, as I said, so it's kind of hard not to increase that. It'll be interesting to see a year from now what those numbers look like. Apple is definitely the safer of the two. That's like Wall Street's baby. So I'd say there are some risks with both. They are at a high. You could say they're a little overvalued, but more so, Facebook is a little bit more cheaply valued, but higher risk, I would say, and it's going to be hard as the world reopens, I think, to maintain these numbers. But at the same time, who knows? I think we've seen a lot of permanent changes in the past 14 months. and these companies could very well continue to thrive and stay at the top. So if I didn't own either of these companies, I would definitely want to. And with that being said, if I didn't own any, I would start averaging in very, very slowly. You know, I wouldn't be rushing to dump all my money in at the height here by any means. If you enjoyed the video today, don't forget to subscribe. This is Vinny from the Investment Club, and I'll see you next time.